The floodgates have opened in the corporate bond markets. Issuers continue to capitalize on cheaper funding costs. Our next guest, though, warns of the sharp widening in the junkier parts of the market. He says bear a resemblance to the move we saw in the mortgage market back in 2007. David Rosenberg, Gluskin Sheff and Associates, chief economist and strategist, with us now. This is obviously, we keep watching, David, for the place that we will see the break, right? Because there's been too many weird things, too much easy money for too long, the cycle going on longer than many anticipated. You're looking at corporate balance sheets.
Right, and it's not just where how the money's been borrowed, but also where's it gone? And it'd be one thing if this whole cycle where we've had over $4 trillion of corporate bond issuance go to finance capital expenditure, and then you could say, well, we're going to have a productivity cycle. There's going to be some internally generated rate of return that's going to cover these debt servicing costs.
Right.
That hasn't happened. This is the weakest capital spending cycle of all time in the context of the biggest boom in corporate bond issuance of all time. So where's the money gone? Two words: financial engineering.
Stock buybacks.
Stock buybacks. And that helps explain why earnings per share have been inflated. And that's the biggest reason why we've had this ongoing, very powerful bull market in equities in the context of the weakest overall economic recovery of all time. So it's a symbiotic relationship where you've got this massive corporate bond issuance, financing stock buybacks, and it's a train. It's really what I call smoke and mirrors. But when you're talking specifically here about the spread between, say, triple C's and double B's.
Right.
And you're right, and that's what happens, is that that's the canary in the coal mine.
And so, I mean, when you talk about a game of musical chairs, which is kind of what this is, music stops, somebody doesn't have a chair. Who's the somebody in this scenario? Because the folks that are the beneficiary of the buybacks are not complaining. They're very happy to have stock valuations disconnect from the real economy, which is basically what's happened here. Who could suffer?
Well, I mean, who is holding on to this corporate debt? So you'd be talking about, say, it could be pension funds, it'd be mutual funds, it would be insurance companies, and so a gamut of institutional investors. It's not really a banking issue this time around. Everybody's always saying, well, the banks are in great shape. It's really about the non-bank financial institutions who are holding on to this. And then you get the spread widening. And don't forget that the financial markets are all correlated with each other. So once you start getting spread widening in one part of the corporate bond market with a lag against other parts of the corporate bond market, it makes funding less accessible. It starts hitting the real economy. And that's where the lag tends to hit the stock market. Remember that the problems in the mortgage market really started about 6 to 12 months before the stock market finally woke up to it back in 2007.
David, what about the fact at some point to financial conditions still being pretty loose? This GTV chart on the Bloomberg showing you the financial conditions remain pretty accommodating as of yet. So what would you say to traditional economists that say this is related to growth?
Well, what's interesting is that financial conditions are absolutely accommodative, no question about it. Why is it then that fourth quarter GDP growth looks like it's getting below 1% at an annual rate? I'm doing the bean count on the fourth quarter. I can't get my numbers above 1%. And then, of course, we slowed down to 2% last quarter. So economists love to talk about easy financial conditions. And then these days, people tie it into, well, financial conditions are easy, therefore, go buy financial assets. But the reason why financial conditions are easy is because of the boom we're seeing in financial assets. The question now it posed back to you is, where's the evidence that this is producing accelerating economic growth? If anything, I would say when you're taking a look at the broad gamut of numbers, the economy is actually in sputter mode right now in the U.S. I'm not seeing any signs. The OECD leading indicator is at its lowest level in 10 years. I'm not seeing any sign the global economy is reaccelerating. People tend to get so fixated on 1 or 2 months of noise. But the financial conditions aren't stimulating the economy. I mean, if you're talking about financial conditions, negative interest rates, you'd be looking at boom conditions in Europe right now. If anything, you're looking at the German economy, which is the engine of Europe, it's barely growing. So the financial conditions, as stimulative as they are, might be giving you an impulse if you're an investor to go long risk, but it's doing nothing for real economic activity.
At least can you count on the health of consumers here in the U.S.?
Well, that's really the big question going into next year. The question is, will the consumer hang on? And there's no question that it's difficult to get a GDP recession when 70% of the economy, called the U.S. consumer, doesn't go down. And of course, 35% of the economy, or half of that 70%, are in things like essentials that never go down in a recession to begin with. So you're talking about cyclical spending. I'm actually starting to notice, by the way, a shift. I mean, we've had now, looking at the retail sales numbers in volume terms, they've been negative 2 of the past 3 months. I find it almost, I laugh when I hear Fed officials talking about how the consumer is so resilient. Negative retail sales 2 of the past 3 months in volume terms, but there's also been a real divide lately in the pattern of consumer spending, that we're seeing that discretionary spending, whether it's restaurants, whether it's jewelry, whether it's clothing, whether it's sporting goods, they've really started to slow down materially. I don't notice restaurants, that's a leading indicator, but people are still accelerating their buying at grocery stores. So when you're eating in and you're not eating out, that's a sign that consumers are becoming a little more frugal, noticing that at the margin. But the key is going to be really here, are we going to start to see employment take a hit? And when we saw the JOLTS data came out yesterday, you're starting to see some fraying in the edges in terms of the churning that we're seeing in the labor market. My sense is that you're going to start to see employment, if not flatten out, then decline over the course of the next 3, 6, 12 months. Because when you get a proper recession like we've had already, it typically leads to companies to start rationalizing on labor. We're going to have back-to-back quarters of negative productivity growth in the U.S. That's telling the business sector that you basically have overhired. So I'd be looking for the employment numbers to soften up and the consumer to follow suit, and that'll be the last game of dominoes, because we've seen rolling recessions throughout the U.S. GDP numbers in the course of the past 12 to 18 months. It, by the way, started with housing when the Fed was tightening,
right,
and it's going to finish with the consumer next year.